Hey, accounting scholars, welcome back. Hope you had a great spring break. Hey, we're going to talk about the recording and evaluating of expenditure process activities. You might remember we talked about the revenue process. That's basically selling stuff, getting orders, and then we have talked about the expenditure process in terms of then actually doing the activities to fulfill those orders. And as we discussed in Chapter 3, and then again in Chapter 6, when we actually created the coffee business and actually did expenditure planning activities in our income statement, we determined various costs associated with the expenditure process. Now, in this particular chapter, we're going to add another piece to the puzzle, and specifically, we're going to learn how the expenditure process events are recorded. We kind of touched on this in Chapter 7, but we're going to go into a significantly higher level of detail, especially as it relates to the purchasing process, the human resources process, and the payment process. All right, let's get rolling here. Let's talk about, first of all, what the four primary expenditure process activities are. And as you might expect, they all fall in logical order. First is the determination of what goods and services you need. That is a good starting point, as you might suspect in a business. What do you have to buy and why? Then secondly, you've got to determine who are you going to buy it from and how are you going to order it, and that would be step 2 in the process. Okay, so you've taken care of step 1. Make sure you get this all in your notes. You've determined who you're going to buy it from, and now you actually then, after you have placed the order, you receive the goods and services. They actually come to your door or your dock if you're a manufacturing organization. And last but not least, then you have to pay people that you bought stuff from. So those are the four primary expenditure process activities. Now, think about this for a while. We've talked about different types of activities, and certain types of expenditure process activities actually trigger accounting events. The two that we talked about that actually do trigger accounting events are the receiving of goods and services. And the reason this triggers an accounting event is that specific accounts are impacted. Your inventory account, which is an asset account, increases, and also your liability account, especially if you purchase things on credit, you have an increase in your accounts payable. The second area is the area of paying for the suppliers of goods and services. So when you actually, when the credit amount comes due, as we kind of talked about in the coffee business, we had 45-day terms that were the on-account terms that we were required to follow when we purchase something on credit. Then you have a decrease in accounts payable and a decrease in cash. So again, kind of on the accounting equation side, there's an impact on the asset side of the equation, and there's an impact on the liability side of the equation. All right, let's talk about the basic flow of information as it relates to the whole inventory control process and purchasing and accounts payable. And there's several steps here, so please make sure you get each of these in your notes. Okay, so we're going to be using this term quite frequently in this chapter, and that's inventory control. Basically, inventory, as we've talked about, is an asset and it has money associated with it. Too much inventory, not good. Too little inventory, not good. So inventory control basically is a system used to determine the need for inventory, and when there is a need for inventory, the inventory control system will essentially notify the purchasing department. Once purchasing is notified, then they place an order with a company or a vendor, saying, "Hey, we need X amount of screens for our iPhones." Once the inventory is received, let's say again in this particular case, there are iPhone screens that were ordered and they were received by the receiving department. They will notify the account that goods have been received. Now, when accounts payable gets wind of this, they basically do a comparison process. And again, these are important steps, so make sure you get these in your notes. They compare the purchase order, and the purchase order is the document typically a company gives to a vendor or to a company that they're ordering stuff from. They then compare that to the receiving report to make sure that the stuff they actually got or received was the same as what they ordered. The vendor will typically that actually supplied the inventory will actually generate an invoice, and if all three of those things are in good shape, then they'll let the cashier know, the person that disperses the cash and pays the bill. Cashier then pays the vendor, and from an accounting standpoint, the general ledger is updated. Pretty simple process. Okay. So, as you can imagine, in larger companies, there are hundreds, sometimes thousands. In fact, in like General Motors or IBM or even Apple, there'll be millions of transactions. So, how do you keep track of all this stuff? Well, there are special journals and special ledgers, which are called just that, special journals and subsidiary ledgers. Now, what is a special journal? Well, basically, for all these recurring frequent transactions, there's a specific journal which capture these particular things. I mean, it could be a journal as related to a particular vendor that has a high volume of orders that you place on that particular vendor. It replaces the general journal for these particular kinds of transactions because there's so many of them, and rather than record them all in a general journal, they're recorded in these special journals. And these could be purchases that are made on account. They could be sales on account. They could be cash receipts, cash payments, wherever there's a large number of particular transactions occurring. Now, on the other side, the subsidiary ledger, again, is used to detail specific general ledger accounts where there's a lot of volume. This subsidiary ledger supports, but it does not replace the general ledger. Where in the special journals, you could actually replace the general journal. These subsidiary ledgers basically support the general ledger, but not replace it. And again, these could be related to accounts payable, accounts receivable, inventory transactions where there's a high volume of activity. Okay, let's move on to inventories. There are basically two types of inventories: a merchandising inventory and a manufacturing inventory. Merchandising, as you might suspect from the word, has to do with primarily retail stores. Specifically where you are buying inventory and using it to be resold. A good example of this might be, let's say you owned an athletic shoe store. You would purchase a large number of shoes from Nike, and you would resell those shoes. That would be typical as a merchandising inventory. And specifically, again, get this on in your notes, you would put those particular items that you receive in a merchandise inventory account. Now, the other type of inventory is a manufacturing inventory. And as you might suspect here, manufacturing inventories are primarily inventories that are purchased to make stuff. You know, they're used to make products. And so typically, inventories that are received in the manufacturing area are put into, again, very important raw materials inventory account. All right, now we are going to move on to two different types of inventory systems, the periodic and perpetual inventory system. But before we do that, I think we'll call an end to our section tonight, and we'll be having a quiz on this tomorrow, guys, so we'll look forward to seeing you in class. Have a great